Adrian Mowat, Managing Director and Chief EM Strategist at JPMorgan, joins us on the line from Hong Kong. Adrian, great to have you on the show. You know, recession fears are pretty much gripping world markets across. We've seen a big slam dunk, so to speak, across the emerging market pack as well all of this week. How do you view the situation right now? Because post the U.S. downgrade, it seems like everybody is a bundle of nerves as far as the near-term outlook is concerned.
Yeah, look, I think this is all a story about growth and recession fears, which one should have. What the U.S. debt ceiling debate was the Republicans and Democrats debating on how to impose a fiscal drag on the economy. It is a very strong message that there's no fiscal flexibility in the United States. The increase in Spanish and Italian bond yields we saw just over a week ago was the markets telling politicians in Europe that there's no flexibility for a fiscal stimulus. The U.S. is suffering from 3.5% inflation. There is no monetary flexibility, and there is a big debate that QE2 was actually counterproductive in that it fueled inflation. So we have very weak economic growth, and I think the key data point this week was Germany's GDP numbers for the second quarter, 2.2% growth. This is meant to be the growth engine of Europe. It is also the economy that people are looking to cross-subsidize peripheral Europe as it deals with its debt burdens. So I think there's some very clear threats out there when it comes to growth. And that's why markets are struggling. And I can't really see a short-term solution for this because policymakers are really out of bullets, and to some extent we're out of clear leadership. There's no obvious consensus in the United States nor in Europe in how to deal with the fiscal stresses that we have there.
Yeah. The other aspect, Adrian, is that now nobody's really calling the downside risk to the market. Earlier people were talking about a 5 to 10% fall, but it seems like with the uncertainty building globally, people are a bit wary about how low the market can go from here.
Yeah, I mean, I think that there's no clear quantitative model that would give you how low can a market go from here. This is about fear and greed, and we're definitely much more in the fear camp. The problem with it for my asset class as the emerging market strategist, and we've had a pretty bearish view all year, and have been very concerned about the growth outlook in developed countries, as well as, which I think is very important for our asset class, is that the BRICS are in a tightening cycle. The policy priority in India, in China, in Brazil and Russia is not growth. They've actually got a fair amount of growth. The policy priority is price stability. And when you're fighting inflation, it tends to be pretty bad for equity markets. And so we've seen with the BRICS a derating of equity markets. I think that will continue until growth slows down and inflationary pressures ease. And then you're going to have a very good buying opportunity for the BRICS, but in my opinion, from a lower level. Out with the BRICS, we have economies such as the Indonesian economy, which is growing healthy without an inflation issue, and their P multiples are rising, and the Indonesian equity market is giving positive returns year to date. So very logical markets. And one thing I'm quite confident about is that decoupling at a macroeconomic level is actually a fact out there, and we're seeing it even at an equity market level where investors are distinguishing between the good and the bad macro fundamentals. And even if developed world growth is extremely low in 2012, I see no issue with a re-acceleration in the BRICS growth if they've dealt with inflation.
But that's the worrying point, Adrian. That's a bit of an unknown entity right now. But Adrian, just wondering, what's your thought on, you mentioned derating. What's your thought on how much lower or how much stronger can the PE compression get? Because the talks with the corporate suggest that the guidance that they had given for FY12 remains intact. So earnings is not a problem. It could really be the market perception about how the price equity multiple should be for emerging markets in a scenario when the global economy is threatening to go into a recession.
Okay, the corporates are saying that their projections are still in line. The analysts haven't cut their numbers. that doesn't tell you that earnings isn't a problem. The market in derating the PE multiple is telling you that earnings is the problem and that we haven't faced up to that problem yet. Central banks are fighting inflation. There is only one way you fight inflation, and that is that you slow down growth. And in slowing down growth, you reduce the demand in the economy, and that results in a decline in inflation. When you slow down growth, corporate profits slow down with it. And the story is that monetary tightening has a delayed impact, and people are too optimistic on second half growth and demand. But what you do as an equity investor is you're investing in a leading indicator. We depress the PE multiples before the earnings downgrades. When growth has slowed down and the earnings downgrades are getting at their most severe, that is often a buying opportunity in markets.
Right. In fact, and which was my next question, Adrian. How do you think you as an equity market investor, let's assume, I'm just putting in that category, would react over the next 6 months? Would you react to the effect of the monetary tightening, which means that earnings might go down? Or would you react to maybe some bit of stimulus packages that maybe even the emerging market governments would have to give, considering that growth overall is slowing down?
No, I completely disagree with this stimulus idea. I think you should just look at this as a very conventional cycle in emerging economies. The intention of central banks is to slow down growth to fight inflation. I'm going to buy these markets once growth has slowed down and the earnings downgrades are becoming aggressive. That is your buy signal. You wait for growth to slow down. And that we don't need a stimulus. There's nothing wrong with these economies, apart from they've been growing too fast and they've stoked inflation. So, my advice is be patient. Get some cash in your portfolio, pick up the golf clubs, and, come back to the markets in a couple of months' time when the data is showing that growth has slowed down and some of these inflationary pressures have been dealt with.
What about the flow of liquidity, Adrian, which is expected in case QE3 happens? And, many argue that once there is that pressure of money coming in and some stability on the fundamentals, or the macroeconomic fundamentals that you just mentioned, we would see another rally towards the end of the year, start of 2012, in the very big markets that you've been talking about.
Okay, I think there's a lot of misunderstanding. Liquidity is an ill-defined term. The opportunity cost of investing in something rather than having it in cash in the bank or in the bond market is extremely low. And so if there is an asset that looks interesting, that has momentum to it, perhaps gold at the moment has momentum, then that will attract capital. But, if I think equities are going to continue to decline because the growth outlook is weak, I would rather have cash earning me nothing than owning equities. QE3, I think, is extremely unlikely. There is a debate going on about whether QE2 was effective. Did the QE2 cause inflation? There's a good argument that it probably did through inflating commodity prices. It was counterproductive. The governor of Texas is suggesting that the chairman of the Federal Reserve Board should be tried for treason. A bit ridiculous concept, but there's definitely a much bigger debate going on. There were 4 members of the ECB board that dissented on the purchase of Spanish and and Italian debt. There is no consensus there out with the central bankers. Do not expect QE3. QE3 will not bail you out. QE2 was not just QE2. It was QE2 plus a fiscal stimulus in that President Obama renewed the Bush tax cuts. You are very unlikely to get a combination of QE2 and a fiscal stimulus again. There is no flexibility. We're in a world where it's going to take time to address these fiscal issues. The only solution, in my opinion, is for China's economy to slow down and for China's slowdown in growth to result in a major correction in commodity markets. That correction in commodity markets would stimulate demand in the Western world through lowering very high inflation or stagflation at the moment.
Sure.
That's the way out of this.
Just before we wrap it up, really, you don't think that is already underway with, as you said, no talks of QE3 happening and the China rate tightening cycle already putting on the brakes in the way the commodity prices are moving? You don't think we are already on the way to a correction, and a major one at that, in commodity prices?
I think we are. We're on the way. We're not there yet.
How much further, Adrian?
How much further what?
How much further of a price correction or a destruction would you believe could happen in the global commodity prices? I mean, leave aside the precious metals. We're talking about the industrial commodities.
Yeah, why don't we just repeat what we did in 2008? So have declines of 30, 40% in commodity prices. It's generally good for the global economy. It's not very good if you're Brazilian or Australian or Russian.
Sure.
But for the rest of us as commodity consumers, it's great news. It's a big boost to our discretionary income.